Gold, silver, platinum, and palladium continue to hold on to most of their recent gains. Meanwhile, in the last couple of weeks, we've seen the three major U.S. stock indexes take a tumble, and Bitcoin has fallen sharply. In this gold market commentary for Friday, November 21st, 2025, we'll review the latest charts for all of these markets and tell you what we think may happen going forward. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We're a national, physical, precious metals, and vintage U.S. and European gold coin dealership. We can help you with any of your needs in the physical arena. We'd be honored to try and help you and to serve you. So let's get on with our update. Stocks and Bitcoin tumble while gold and silver hold gains. The major U.S. stock indexes have rolled over from their October highs and are now, all three of them, the Dow, the Nasdaq, and the S&P, are testing first support levels lower as they have undergone a pretty big profit-taking move since their October highs. Concerns over interest rates, over valuations, growth expectations, sticky inflation, and future economic uncertainty for the U.S. are the causes for the rollover. Meanwhile, Bitcoin has taken a big tumble, and it's fallen back to April lows during the time of the April tariff turmoil. It shows how Bitcoin is more speculative. It offers greater rewards on the upside, but greater risks on the downside than steady gold in the current market environment. Meanwhile, we've seen U.S. Treasury yields and the dollar rebound a bit, which would normally pressure precious metals a bit lower, but that's not really happening. Gold, silver, platinum, and palladium are continuing to hold most of their recent gains as the consolidation continues. And we've also got some updated graphics on U.S. debt now that the fiscal year for the U.S. for 2025 has ended in September. Let's get on with our charts. This is a 6-month chart of the Dow, open, high, low, closing bars. And you can see how the market took off from about 46,750 when Chairman Powell signaled that the rate cut cycle was going to start over again during his August 28th Jackson Hole speech. The market moved much higher. We had a lot of AI enthusiasm in the meantime, and now we've had a big rollover that's coinciding with the Fed meeting at the end of October, where they did cut rates a quarter point, but Chairman Powell indicated that the December rate cut, which the markets thought were a lock, may not actually be on the table depending upon the data. And now we've seen the market roll over pretty sharply and is testing major support at 46,750. Today, the Dow closed at 46,250. Just a hair below that green support line, but that's a major support line, and now the Dow is testing it to the downside. And we're seeing similar action in the S&P 500 large cap index, move to record highs following Powell signaling rate cuts, then the Fed cuts starting in September and in October. But again, once Powell signaled the pivot, markets started to roll over. Today, the S&P closed at 6602, above the support level where we have it by a couple hundred points, but it did test it earlier today on weakness. So the S&P looks tentative as well. And now we've got the Nasdaq in the same exact kind of a pattern, testing support at 22,200. It closed today at 22,273. So all three of the major U.S. stock indexes have made all-time highs, and now they're rolling over on profit taking for a host of reasons. Let's look at Bitcoin next. This is a 9-month Bitcoin chart taking us all the way back to March, which shows the April lows that we are now approaching at 74,400. Bitcoin closed Friday, November 21st at 85,111. It was lower on the day before it bounced back up, but it has clearly broken first level of support at 99,000, and that next level of support is at 74,000. So there's been a lot of profit taking on Bitcoin over the last 2 weeks in particular, and it has tumbled quite a bit, showing how Bitcoin is much more volatile as still a bit of a speculative asset, but it has become much more mainstream correlated, as many of you know, over the last several years with major adoption of Bitcoin by major financial houses and hedge funds. We're finally getting some data out of the US government now that the government closure has ended. We've got the September jobs report, with September coming in at 119,000 new jobs. We got this just a couple days ago. There will not be a jobs report for October. There will be a November jobs report released on December 16th, which is a week after the final Fed meeting of the year on December 8th and 9th. Yeah, 8th and 9th. Meanwhile, the previous 2 months, July and August, were revised down a total of 30,000 jobs. In total, August was revised down 26,000 jobs from 22,000 jobs, which takes it to minus 4,000 jobs. And July was reduced 4,000 jobs from 76,000 jobs down to 72,000 jobs. The first 4 months of job creation this year have all been in the 100 to 120,000 job range. Then once the tariff turmoil hit in May, June, July, August, we've seen much lower job hiring by companies who just don't know how these tariffs are going to affect them. We finally got a boost in September. We won't have an October report, as I told you. We will get the November report on December 16th. So it's anyone's guess how the economy is really going. We are seeing more layoffs than we've seen in quite a while as well, according to Danielle DiMartino Booth, as I follow closely. So the U.S. may be slowing down a bit economically. It's hard to say for sure without a lot of the regular job reports that we normally get that we haven't gotten because of the U.S. government slowdown. Meanwhile, the Fed has cut rates again at their October meeting, taking the federal funds rate down to as low as 3.88%, while the 10-year Treasury yield has puffed back up and moved over the federal funds rate in a surprising bit of a rise during this rate cutting cycle. And right now, if you look at the two blue arrows, upward arrows on the chart, you can see that the gap between the Fed funds rate right now is almost as big as it was back in March, when the Treasury yields were substantially higher than the federal funds rate, meaning the market was wanting more of a premium for the risk involved in holding US 10-year Treasuries than the federal funds rate would indicate. So the Fed's losing a little bit of control of the market here. We'll see how that continues to go. Right now, it's anybody's guess whether we get a rate cut in December or not, which has certainly affected this. And the fact that that was taken off of the table by Chairman Powell at the conclusion of the October meeting would help to buoy this up a bit. But this looks like it's a bit more than just, hey, maybe they won't cut rates after all. So we'll have to see how this goes. Meanwhile, the dollar has also gone into a bit of an uptrend. Nothing too great, but it's broken away from that modestly downward channel that it's been in for the last 2 months. It's hit a double top at about 100.2 on the US dollar index, just below that support and resistance line at 100.50. So the dollar's a bit stronger and yields are a bit stronger, and you would think that this would pressure gold and silver lower, but it's not having as much of an effect as you might think it would have with everything that's been going on. Let's get into the metals charts. Here's a 6-month candlestick chart for gold. And you can see the big run that we've had since August, late August, all the way up to 43.81. Then the big correction as the froth came out of the market. We've bounced off of 3,900, hit a top at 42.50 was where we hit the first level of resistance. And now we're bouncing lower, holding support at 40.25 in sideways to tentative trading. This is a classic consolidation phase, sell off, bounce, sell off again. We could get another bounce. We've got a rising bottom as indicated by that blue trend line and a falling top as indicated by that red trend line, which leads to a pennant pattern or a flag pattern. And typically when we reach the point of that flag pattern in about another month to 6 weeks, that's when the market makes a decision whether it's going to move higher or lower in earnest. So we're in a kind of a classic consolidation phase with gold holding pretty well at major support, major first level support at 40.25 right now. It closed today Friday, November 21st at 40.65, comfortably above after testing 40 and a quarter earlier in trading. Meanwhile, silver is in the same kind of a phase as gold, but it's a bit more volatile, and it is testing that first support level at 49.50 a bit more aggressively than gold has. We broke below it today to get into about 48.80, but the market got bought up again, and that's what we've been seeing. Every time silver gets sold off, it's been bid right back up, usually in the same trading session, which is why we're getting kind of tight candles with big wicks to the downside and to the upside. That's the market moving above and below the open and the close, those little wick lines. So we've got a rising line for silver, but we tested it today and bounced off of it and moved higher. The market for silver does look a bit more tentative to me than gold. Remember, silver is always a bit more volatile than gold in situations like we're in now, consolidating gains after a big move. I wouldn't be surprised to see silver break 49.50 and grind down just a little bit lower. I like silver under $50 an ounce as a buyer. I think that is a good value. We closed the market today at $50.50 in the spot market. Meanwhile, platinum has got a pretty flat bottom right at 1,500. We've been bouncing off of that on several occasions. We got a little bit lower than that today, but we closed above that at $1,520 per ounce. But flat bottom and falling top usually leads to a pinch that might lead to a lower market. We'll have to see. Again, that move won't be for another probably 6 weeks to 2 months if we go that far without breaking lower. But I would buy platinum at $1,450 if we get that opportunity. We closed the market today at $1,520 per ounce. Palladium showing similar moves like platinum, but it's been testing that 1380 support level a bit more aggressively, showing a bit more weakness in just the last couple of trading sessions. It hasn't been quite as strong as platinum. We've got resistance at 15 and a quarter on the upside with support at 1380. We got under support at 1380 earlier today, and we closed today right at 1381, right at that support level. So I wouldn't be surprised to see palladium leak a little bit more and probably test 1350, maybe get down to 1300. That would be a real opportunity to buy palladium if we get that low. With the recent moves for gold and silver, we've got the gold to silver ratio climbing just a bit, with silver leaking a little bit more relative to gold. Today, the ratio is at 81.21 to 1, where just a week or so ago, it was as low as 78.75 to 1. We're in consolidation phase, so I would expect to see the ratio continue to bounce around about 80 to 1 for the next couple of weeks until we get a bit more information on how well gold and silver will hold support or whether they'll be punched up a bit higher or not. Time will tell. Now that the fiscal year for 2025 for the U.S. government has ended, I've updated the latest charts for U.S. debt and tax receipts. So here's a visualization for you to see how much money the government takes in every year. In taxes, right now it's a little over $5 trillion, but we continue to spend a little over $7 trillion, making our deficit around $2 trillion on an annual basis today. If you go back to 2000, you see that we actually had a balanced budget for a couple of years, and then we went pretty close to a balanced budget for the next 6 or 7 years till the great financial crisis hit. The money printing presses got turned on in earnest, and then how that really gapped higher once we got into the COVID economic closures and $6 trillion of new debt and lower receipts. So that is a pattern that is going to probably continue as we go forward. I don't expect this to narrow, which is why the US government is in a bit of a debt trap. More than a bit of a debt trap. We're nearing the end game of this debt trap is actually what this is all signaling. If you look at a bar chart of the annual federal budget deficits, you can see how they've just continued to move higher over time, how they exploded higher during COVID, 2020 and 2021, how they've moderated a little bit since then, but now we're grinding back up again, where we just simply spend more than we take in. And this is during a time when the economy's been okay. If we go into a bigger economic slowdown, we'll take in less taxes, but we'll probably spend more, which will make this deficit grow higher, faster, which will make our debt grow higher faster and make our interest expense payment grow higher and faster. And this is a chart of our federal interest expense on our debt. And you can see just until about 2021, we were spending between 400 billion a year and 600 billion a year in interest on our debt. And now we're spending $1.2 trillion a year simply in interest on our debt. And this is where the debt trap really lies. If our debt continues to grow and if we see treasury yields continue to rise despite what the federal funds rate is, and our interest payment percentage continues to increase while the debt continues to increase, that's where the debt trap springs wide open. I recently heard a very insightful interview from Jeffrey Gundlach, who is very concerned about this. If you're interested, just Google Jeffrey Gundlach interviews in the last week or so, third week of November. You'll find the interviews that he's been talking about this, and it's not good. And he's the bond king, one of the most conservative guys on the planet. And he likes gold. So this is what our website looks like. If you'd like to check us out, we have live, online, transparent pricing on the most widely traded, competitively priced physical bullion and vintage US gold coin products. And most importantly, the most easily sellable products for you if you decide to invest in these markets. Please subscribe to our YouTube channel, where we continue to put out timely, factual, and hopefully for you, potentially actionable information. Here's our contact information if you'd like to contact us via email or check out our website. So I hope everyone has a wonderful Thanksgiving holiday. Thank you so much for your loyalty and trust that you've placed in us over the last now 27 years. We'll look forward to seeing how these markets evolve over the next several weeks as this consolidation phase for precious metals continues to go on. And more importantly, we'll see what happens with the major stock indexes around the world. And it's not just the US that's been weak, it's been Asia and Europe as well. So we're seeing a rollover in all of the global stock indexes after hitting pretty much record highs around the world. Some of that AI froth is starting to come out, and there are some worries about global economic growth going forward. So it's going to be an interesting time going forward. So thank you so much again for your time today, and good luck out there.